Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And something really rare and unusual happened earlier this month in the market, and that is, as we've covered in recent videos, the fact that the VIX index, which is in essence the way that the options market measures how volatile stock prices are, the VIX index spiked above 65 earlier in the first week of August, which is a massive number. And just like we've pointed out in recent videos, this is so rare that it has only happened 4 times in the last 10 years. And so any solid full-time trader has a playbook for unique situations in the market, like a huge spike in the VIX, because they can turn into incredible opportunities that can constitute a major portion of your trading income in a given year if you're ready for it. And not only should you understand what strategies have a track record of working brilliantly in a VIX spike situation like we're going to be discussing in today's video, but it's just as important to understand what not to do, because it's very easy to fall into a trap when trying to take advantage of unusual events using options. And so the purpose of this video is to both share with you what has worked historically when the VIX spikes, and at the same time to warn you about what fails miserably. And even though on the surface, it might seem like the logical trade to make. So if that sounds interesting to you, then stick around, because I think you'll be surprised at what does work and what doesn't work during a VIX spike. Now, before we get into the option strategy that we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. So if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we'll be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Let's examine the last 4 times that the VIX spiked. And it's important to understand that essentially every time that you get a huge VIX spike like we did on August 5th, it is invariably caused by a huge, often sudden, unexpected sell-off in the market in reaction to some macro event. And so what that means is that on days that the VIX spikes, the market is almost always experiencing a sharp gap down that morning. So let's take a look at the first of these 4 events over the last 10 years. And that was on August 24th, 2015, when the Chinese stock market had a huge sell-off overnight in reaction to a Chinese government devaluation of its currency, the yuan. And that sell-off was so violent that it caused the VIX to spike above 50 and the US market to gap down over 5%, which is a massive gap for an index. And so you might think that the best thing to do in a situation like that is to buy a put option using SPX index options, right? Because after all, index put options go up if an index goes down, right? And so let's open up the first options chain that's more than 6 months away, which in this case is the March 18th, 2016 options chain. And as you can see, if we wanted to buy a put option with the strike price as close as possible to the SPX opening price of 1868 that day, then we would choose the 1875 put, which was priced at 175.55 that morning. We'd pay $17,555 for that option because each index put option pays off $100 per point below its strike price. So you multiply the price by 100, resulting in a total cash cost of $17,555. So that might be the natural thing that would occur to you. But in fact, we need to look at an alternative, which is really on the surface kind of counterintuitive. And that is that instead of buying a put, assuming the market will keep going down, might it make more sense to instead enter into a bullish trade with the assumption that after the sell-off takes place, as has always happened historically, the market will bounce, and often to new highs. And so as an alternative, let's pull up that same options chain, but this time, instead of buying a put, we're going to go out onto the call side of the options chain, and looking at that column called delta, find the option that is closest to the 70 delta call option, which in this case is the 1675 call with a delta of 69.98. And we're going to go ahead and buy one of those, and then at the exact same time, head up 15% above that strike price, which in this case is the 1925 strike and sell that one. And so when you buy a call lower on an options chain and sell a call higher on that same options chain, then you are entering into what options traders refer to as a call debit spread. Just by way of explanation, an options delta is a measurement of how much an options price will move based upon how much the underlying asset that it's derived from moves, which in this case is the SPX index. And so for reasons that we'll need to cover in another video, because it takes a lot of explaining and it's not really the main focus of today's video, just please accept that it's advantageous for certain bullish option strategies to buy call options whose deltas are 70 or even higher, and at the same time to cut down the cost of those strategies and the amount of cash you're going to need to pay to implement the strategy. We sell another call option higher up the options chain. And the reason that we do that is primarily to cut down the cost of the strategy, because as you can see, the cost of that 1675 call is $26,235, but we cut the full trade cash outlay down by selling the 1925 call, collecting $10,090, resulting in a net cost of $16,145 to enter into the trade. And so now let's move to the last trading day of these two different trades, and that's March 17th, 2016. As you can see, as so often happens after a big sell-off accompanied by a VIX spike, the market ends up higher at some point. And while this was certainly not a straight grinding rally, but really a much more choppy rally, but by the first quarter of the next year, the index had rallied 9.2% to 2040.59 on the last trading day of this March options chain. And so let's take a look at our put option on that final trading day. And as you can see, the put has become essentially worthless, worth about 2 cents, as you can see. And so if we sold it at the end of the day, then we would have taken a bath on that trade, with the initial cost being almost completely lost. Whereas now, let's take a look at the call debit spread. And as you can see, that's a completely different story, because having reached the end of the options trading life, with the index trading at 2040.69, about 365 points higher than the long call strike price, that option will pay off $100 per point for the 365 points that the index has exceeded its strike price of 1675. So naturally, that option is going to be worth that amount, because obviously that's a very valuable right to own. And so as you can see, it's trading at 364.95 minutes before it stops trading. And similarly, the 1925 short call is worth 115.05, because if we let it expire, we would need to pay the owner of that call about $100 per point that the index is trading at, which is about 150 points higher. And that's why that call's price is so close to 115. And so the way that you close a call debit spread is to sell off the long call and buy back the short call. And so if we were to do that, you can see we'd be cashing in the long call for $36,495, and we'd have to pay $11,505 to close the short call position at 1925. And then subtracting out the initial cost of the trade, you can see that we made $8,845, which is a gain of 54.7% against our original trade cost of $16,145. And so buying the put ended up being a disaster, whereas buying the long call and subsidizing its cost with the short call, in other words, the call debit spread, resulted in a fantastic return on that trade. Okay, so now let's move to the next time that this VIX spike over 50 happened, which was on February 6, 2018, in the midst of a large sell-off that started in early February of that year. And so that morning, the VIX spiked over 50, and as you can see, the index had been gapping down for days, every morning. And on this particular morning, opening at 26.2352. And so again, let's compare the two strategies. First, buying a put at the nearest strike price to the opening price on an options chain a little more than 6 months out, which in this case is the September 21st, 2018 options chain. And as you can see, that put option was priced at 167.55. And again, on the surface, you'd think that was the way to respond to a sell-off by assuming there was going to be a continued downward momentum. And of course, that translates into an initial cost of $16,755, whereas the call debit spread using the 70 delta long call at 24.25 and a short 15% higher up at 2,800 happens to cost exactly $24,000, as you can see from the calculation. And again, as we move to the last trading day of this example in September of 2018, you can see that again, the market took advantage of that panic sell-off, which caused the VIX spike earlier in the year and rally to 29.3075, an increase of over 12%. And looking at the put trade, you can see it again has lost virtually all of its value, causing a loss of $16,753, whereas the call debit spread was a different story because the long 24.25 call increased substantially up to 506.60, while the short call up at 2,800 also appreciated, but not by nearly as much, to 131.60, resulting in a trade profit, as you can see from the calculation, of $13,500, which is a 56.25% gain. Now, moving to the next time this happened, which was during the sell-off resulting from the COVID-19 pandemic back in 2020, as you can see on March 6th, the next time the VIX index exceeded 50, the market had been gapping down for weeks, most mornings, and had gapped down again to 2972.08 that morning. And so again, if we look at the at-the-money put trade, it's priced at 246.60, which means that the trade cost is $24,660, whereas the call debit spread is comprised of the 70 delta call, which is the 26.75 long, combined with the 30.75 short call, 15% higher up the options chain, resulting in a call debit spread, which this time is a little more pricey at $25,160. And again, moving forward to the last trading day of this options chain, we can see that after crashing a lot more, the index and really the whole market bounced substantially, resulting in a historic rally with the index trading at 33.5771, up 13% from when we entered the trade. And so as you'd expect, the put, given such a huge rally, again lost essentially all of its value, resulting in a trade loss of $24,643, while the call debit spread had large increases in value in both the long and short calls, but a much larger increase in the long call, resulting in a trade profit of $14,800, which in this case is a 58.82% return. And just in case you're wondering, had we put the call debit spread trade on August 5th, just last week, when the market gapped down and the VIX spiked over 65 in the pre-market, we'd be long the 48.50 and short the 55.75 at a total cost this time of $47,720. And as of today, the options pricing looks like this because the rally that has occurred since that sell-off on August 5th has caused the position to be up $3,700, but it's got many months before expiration, so we shall see. And so by now, it should be obvious that buying the put when options volatility is so high right after a VIX spike, which means that options will be a lot more expensive, just outright buying a put is usually a really bad idea, as we saw repeatedly in these examples. But buying a call debit spread can be a great idea when done intelligently. And if you think about it, there's a good argument that buying the call debit spread is the far superior way to trade a crash. And I say that because if you compare the results of what the index returned versus the call debit spread, in all three cases, the call debit spread over that same period of time was a far, far superior use of capital, as this slide illustrates. And so what I'd like you to take away from today's video is that you should be aware of the fact that when you get these big VIX spikes, that there's actually an amazing opportunity available to you. And the irony is that the opportunity is on the upside of the market, all in the context of almost always a hard push down in the market. And as you develop your playbook as an options trader, you might want to keep this in mind as a trade that has a solid track record of working out. But of course, like everything else in life, There are no guarantees.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.